following paid commercial program is brought to you by TD Wealth.
Hello and welcome to the show. It's great to have you with us. For the 10th time since March of last year, the U.S. Federal Reserve has raised interest rates, taking the overnight rate 25 basis points higher to a range between 5 and 5.25%. That is the highest we have seen since 2006. But the Fed also signaled it's taking a more cautious approach to future rate hikes. More on what all that means and what the market interpreted. We're joined by Hafiz Noordin. He is portfolio manager at TD Asset Management. It's nice to have you here in person.
It's great to be here.
Let's just start out with what was said in the statement and both in the press conference afterwards. What stood out for you?
Right. Well, we all got the 25 basis point hike, which was expected. And we also expected that there was going to be some kind of moderation in the language in the statement around the path forward. And we did see that. The language before was more about anticipating future rate hikes. And that got shifted towards monitoring the extent to which future hikes would be needed and monitoring the data and the impact of past rate hikes on the economy. So I think from that sense, this statement almost tilted a bit dovish. The market reaction, the knee-jerk market reaction was a bit more around, bond yields coming down a little bit, the U.S. dollar weakening a little bit. But in the press conference, Chair Powell did kind of give the other side of that, really focused up front on the battle to get inflation back down to 2%. And I think from that perspective, yes, we got a bit of a pause here, but there's definitely still a hawkish bias behind that.
Okay, so there's a pause and a hawkish bias, you think. Are we close to done? We keep thinking, I mean, if even if there is, it feels like there's more rate hikes behind us than there are in front of us, for sure. Right. So I guess so we're not done yet?
Well, I think, the market would say yes, they're done. I think if you listen to Chair Powell, he doesn't want to use the word pause. I think if he says the word pause, the market will hear pivot. Yes. And that will lead to a much more, loosening of financial conditions more than what they want in order to battle inflation. So yes, I think for the most part, they appear to be done at this point. They acknowledge that there's this tightening in credit conditions that's happening from all of the, reshoring of bank balance sheets right now, given the stress of the banking sector. That itself causes, the equivalent of rate hikes in the economy because lending conditions will be harder to households, to companies. So that's going to do some of the work for them. So I think they've kind of said, yes, we've done 500 basis points of hikes over the past, over a year or so. They can kind of step back and kind of monitor, see the effect of that. But they want to have the optionality to, not necessarily commit to cutting after this. They'd like to have that balanced approach from here.
Everybody wants optionality, and they're keeping it for themselves, too. Let me ask you, inflation, obviously the primary focus. And, we've been getting lots of, I'll say, headline economic data, labor, that's been pretty stable, pretty bullish, actually, in fact, in terms of the health of the economy. I'd say under the surface, we do see some things, a different kind of, I'll say, real-time indicators, which do show some slowing down. What do you think is going to have the markets realize? And that's I'm putting the question probably in the wrong way because maybe that's not happening. But what's going to have the markets maybe think that the economy is slowing down more drastically than the indications we've seen thus far?
Right. Well, there's definitely been, in the hard data, so the actual, number of jobs that are being created. We look at the non-farm payroll data as kind of one of those key metrics of saying, how many people were actually hired during the past month. And so you have to contrast that with some of the forward-looking, what we call soft data, based on surveys and sentiment. And some of that forward-looking data does show that there is, we're coming off the boil. The JOLTS survey is a good example this past week, where we saw that the number of job openings relative to the number of unemployed has come down a lot from its peak, which used to be about 2 times when you look at that ratio, now down to about 1.6. So there's 1.6 job openings for every unemployed person in the U.S. The typical level is 1 to 1.2. So we're kind of halfway readjusting from that really peak tightness in the labor market based on that measure. So we're going in the right direction in terms of what the Fed's trying to accomplish. But I think it's the hard data, the non-farm payroll data, where if we really starting to see misses in that data, really lower numbers than what's kind of, average, the average is maybe 150, 200,000 jobs per month. That's when I think we're going to see more of a reaction in the market that we could be getting into what really is more of a deeper recession.
I feel silly for even saying this, but maybe not, because I know Chair Powell actually said something like this. But is it different this time? Because there's so many different cross currents. You have nearshoring happening. You have things that are very stimulative at the same time when you have things tightening at the same time. Does it net out so it's not so bad?
Well, it's definitely surprised the Fed to see this much resilience in the labor market. So it feels different in that sense. But I think I would suggest that it's very similar to past cycles, where this is the time when you still do have, when you look at backward-looking data in the economy, you see this strength. But when you look at what rate hikes have done, they are causing this sentiment in the banking sector particularly to deteriorate, where banks are not going to be as willing to lend money the way they did before. And that will, similar to past cycles, it should mean that corporates and households will see a slowdown in their ability to consume. So demand will start to go down. I think what's maybe a bit different is always just the length of these cycles. You think that with all of these hikes, we should see an immediate downturn in the economy, and I think the uncertainty is just more of a when, not an if.
And maybe the one thing that's different this time is patience. We're so used to things happening so quickly that just things take time, and that's what we're getting there. Right. Hafiz, it's great to have you here. Thanks so much.
Thanks very much.
Hafiz Noordin joined us. Of course, he's portfolio manager at TD Asset Management. All right, still ahead, part 2 of our series on options trading. We're going to hear from Brian Rogers of TD Direct Investing about some basic strategies investors can use. And later, AI is here, the impact already profound. That's according to Kathy Wood of ARK Invest. Highlights of that interesting conversation from Money Talk Live later in the show. You're watching Money Talk. We'll be right back.